Listen closely because what I am about to tell you is the difference between complaining about gas prices and actually getting paid by the companies that sell it. I am 27 years old and my net worth sits at $124,560 because I stopped listening to broke people and started following the actual cash flow of the biggest players on the planet. My next-door neighbor is an oil trader for a big refinery, and he just told me they have already hit their full year 2026 cash flow target. Folks, it is only May if a mid-sized Alabama refiner is already 8 months ahead of plan. You better believe that Chevron, Exxon, Mobil, and ConocoPhillips are sitting on the biggest pile of cash big oil has seen since 2008. The only real question is, what are they going to do with all that money? Well, today I am going to tell you exactly what is going to happen. Brent crude is over $100 a barrel and probably going much higher. The Strait of Hormuz is half shut or fully shut depending on the day of the week and who you ask. Iran and the US are nowhere close to an agreement, and American oil companies are absolutely printing money. I want to show you two sleepy stocks that are likely to get bought out for a 30 to 50% premium very soon. The big oil companies will almost certainly pull the trigger before this year is over. Be sure to subscribe to the channel because when the market is this good, you need to be taking advantage of every single opportunity. Let us start with the facts about Chevron. Their production is up 15% year over year. The US refineries hit record throughput in March. Exxon Mobil is on pace for more than $40 billion in free cash flow. This year, Conoco is looking at another $15 to $20 billion. That is conservatively $80 to $100 billion of excess cash piling up on the balance sheets of these three companies in a single year. So how are they going to use it? Wall Street wants buybacks and shareholders want dividends, but that is not what oil executives are actually going to do. You do not grow a $100 billion oil company with just buybacks. You do it with acquisitions, and ideally you want vertically integrated ones. It makes life simpler for them, and it generates a lot more profits. You buy the pipelines, the gathering systems, the processing plants, and the export terminals that connect wells in West Texas to the refineries. On the Gulf Coast, that is where the real power lives. Exxon already bought Pioneer, and Chevron already bought Hess. The upstream consolidation is mostly done, so what is left midstream? The plumbing of the entire industry there is one sleepy mid-cap pipeline name sitting right in the middle of Chevron. As biggest production region, this company has spent the last 6 months reshaping itself into what I believe is the cleanest acquisition target in the entire industry. The company is Plains All-American Pipeline, and the ticker is PAA. At $20 a share, Plains is worth around $15 billion. That is less than 1/20th the size of Chevron. It also pays a 7.5% dividend, so it is a total cash cow, but most retail investors have never even heard of it. Plains moves over 7 million barrels of crude oil and natural gas liquids every single day. They own the largest crude oil gathering and pipeline network in the Permian Basin, the same Permian Basin where Chevron is the second largest producer behind only the Exxon Pioneer combination. But here is what makes PAA stock such an obvious acquisition target for a giant. For the last 6 months, Plains has been quietly transforming itself into a perfect bolt-on. In the next 2 weeks, they are closing the sale of their Canadian business for $3.75 billion in all cash. And they just bought 100% of the Epic crude pipeline system for $1.3 billion. So when the dust settles in late May, Plains is a pure-play Permian crude oil midstream company with billions of dollars on the balance sheet. Maybe this is all coincidental, but to me this looks like a company dressing itself up for a buyer. And as I mentioned, there is exactly one logical buyer, which is Chevron. Chevron pays Plains tens of millions of dollars in pipeline tariffs every year just to move their own oil out of the Permian. That is every barrel every day. It is like a toll booth on the largest oil major in America. If Chevron buys Plains, these tolls disappear forever. They pick up dedicated pipeline capacity for decades. They get an export terminal in Corpus Christi that lets them ship straight to buyers in India and South Korea. Those are the buyers paying the premium prices right now. The math is staggering. At a 35% premium to today's share price, Chevron could acquire all of Plains for under $20 billion. Plains throws off roughly $2.7 billion in adjusted EBITDA, so the deal pays for itself in synergies in about 7 years. For a company like Chevron generating $4 billion a quarter in free cash flow, that is a total no-brainer. PA stock is up on the year with the rest of the sector, but it has not moved much. In fact, the stock has been consolidating since early March. This is exactly what it looks like when smart money quietly accumulates before a buyout announcement. Now, by the way, if you like content like this and you want the actual trades I am taking, you need to join my Black Ops trading service. For just $5, you get an entire year of access. You get live 1-hour weekly mentoring sessions with me and other members plus a second session every Thursday. You get bonus reports and bi-weekly newsletters and trading view indicators. It is just $5 for one whole year, which is an absolute no-brainer. Click the link in the description or scan the QR code to get signed up right now. Now, we talked about planes, but you do not have to bet the farm on just one name in all likelihood. They are going to be one of several public companies that gets acquired in this cycle. And that brings me to the second name on my list. This one is the dark horse, and the ticker is KNTK, which is Kinetic Holdings. It is about $48 a share, which might seem expensive, but the market cap is only $8 billion. This is less than half the size of Plains and tiny by big oil standards. Kinetic owns gathering systems and processing plants in the Delaware Basin. That is the most prolific subbasin of the Permian, and their assets are literally adjacent to Chevron's most productive acreage in West Texas and New Mexico. A buyout here would be pocket change for a giant like Chevron, but it would lock in midstream takeaway for some of the highest margin barrels in the entire U.S. oil patch. Wells Fargo just upgraded Kinetic to overweight in March. The smart money is finally paying attention. Kinetic just issued 2026 EBITDA guidance of $950 million to $1 billion. That is an enormous amount of cash flow for an $8 billion company. It is an absolute no-brainer bolt-on acquisition. Look, folks, big oil is sitting on a generational pile of cash. The best way for you to figure out what they are going to do with it is to follow the money. You have to figure out what makes the executives the richest. If they make an extra $1 billion this year, the CEO cannot just put it in his personal checking account, but almost all of them have performance-based compensation bonuses based on the stock performance. They are financially incentivized to see their stock price go up. Dividends actually make a stock price drop because you are taking money out of the treasury. They could authorize buybacks, but the Inflation Reduction Act put a federal tax on those, but you know what is not taxable? Acquiring another company, that is an expense that is tax deductible, and it materially increases the company's value. PA fits this mold to a T, and so does Kinetic. These are pure play midstream stocks that would unlock serious value. If you are not familiar with buyouts, the process is pretty simple. By the time the deal is announced, the stock will already be up 30 or 40%. The move is almost instant. Unless you have a fiber line tied into the exchange, you cannot wait until the news breaks. You absolutely must be positioned in the stock before the news comes out. If they do get bought out, it is almost impossible not to make money. You do not need to do any fancy tricks or sell at just the right time. Buyout offers come at a price above where the stock is currently trading. This is the takeover premium, and it is always there. No board would ever approve a buyout for a price below the market value. You will typically see a 30 to 50% premium. The next morning, the stock is going to gap to the buyout price, where it will sit until the deal goes through. Which of these two stocks is the better bet? Personally, I like PAA a little better because it is the cleanest setup. It is cheap and profitable and strategically necessary. And again, this is the one my neighbor believes is definitely getting acquired. The plan is simple. You buy quietly and you wait. Kinetic is slightly more volatile, but it may have more upside if a bidding war happens. I would urge you to keep an eye on both of them because as soon as one gets bought, the other will move too. Investors will reprice the entire sector as buyout targets, based on that premium. Do not forget to subscribe to the channel and click the link in the description for the Black Ops service. It is the best $5 you will spend this year. You will be with me for 12 full months of live mentoring and weekly newsletters. I used to sit in my empty apartment eating ramen so I could afford to buy shares of companies like these. Now I have the results, and I am telling you that the opportunity in 2026 is massive. Stop being a spectator in your own financial life. Get your money into the plumbing of the economy before the big boys take these companies private. I am done talking for today, so go out there and take action. I will see you in the next one where we talk about the power of dividend reinvestment. I am out. Listen to the market and follow the cash. The numbers do not lie. You can either be the one paying for the oil or the one owning the pipe. I know which one I am choosing. Every single day the gap between the rich and the poor grows because of these decisions. Choose to be on the side that owns the assets. I am 27 years old and I am just getting started. $124,560 is just the beginning of the snowball. Watch how fast it grows when these buyouts hit. Do not say I did not warn you. The clock is ticking on these midstream names. The cash is piling up and the deals are coming. I will see you guys in the next video. Peace. Stay disciplined and stay hard. Money is a tool and you need to learn how to use it. No more excuses. No more procrastinating. Click that link and get to work. I am out for real this time. See you in the next one. Goodbye. Stay focused. Always be buying. The truth is, in the numbers, follow the money. Profit is the goal. Freedom is the prize. Let us go. Final word of advice is to stay patient. Wealth is built in the waiting. The buyouts will come. Just hold your ground. I am out.